Volatility, we're seeing plenty of it in the stock market lately, but also in the bond market. What can an ETF investor do to cope with these trends? Today we have Som Seif, the president of Claymore Investments, to describe all this. Welcome, Som.
Nice to be here, Jonathan.
So we'll start here with interest rates. I guess you could argue, why have bonds at all if you know that interest rates are going to rise and therefore bond prices fall?
Well, I think it's a great question. I think we're going into a period here where people are very familiar with volatility in equities, but they often forget about volatility in bond investing. And we are going to be going into a volatile period for bond investors as well. And that's really related to the fact that rates are very low, and over the long run, rates are likely going up. Now, there is speculation in Canada that rates in the short term, very quickly here, the Bank of Canada will start to raise rates, and that will have an impact on investors' bond portfolio. So the key thing to remember before we talk about what the impact is what's the reason you own bonds? It's for, one, income, and two, diversification. Because bonds are a phenomenal diversifier within a broader portfolio context. So they really give you a core part of a portfolio to diversify your risks of the long-term investment portfolio. So those are the two things that are very important that people have to step back and remember. Even though we might see volatility, bonds still play an important role in an overall portfolio construction.
And a lot of advisors that probably you talk to say keep the bond ladder intact. Don't be shaken out of this. To go 100% in equities, particularly now, maybe that makes no sense either. You have a laddered bond ETF, correct?
That's right. I think that first off, laddering to me represents one of the great long-term strategies for any bond investor, because through any type of environment, ladders generally will perform quite well. They will, of course, have, just like any other bond portfolio, a negative movement potentially in a rising rate environment. But what you're doing is you're always taking your coupon and reinvesting it into higher rates. And more importantly, when bonds come, the sort of short-term bonds come into maturity, you're taking those and reinvesting them into the longer end of the ladder. So let's take an example of a 1 to 5 year ladder. As your bonds come to maturity, your 2s become your 1s, 1s become 0. You take the 1s and reinvest them back into the 5. And so you're flowing up and down with the bond, with the yield curve, which is really great for a long-term investor. You don't have to play and speculate on interest rates.
Right, you do have a new product coming out which allows you to do that, to actually an inverse bond fund on 10-year Canadas, correct?
Well, yeah, and this is a product we'll be launching in the next several weeks, and I think it's something, really is a tool for the investor that wants to hedge against their interest rate risk in a bond and portfolio. So take the example, if I'm a 60%, 40% investor, equities and bonds, likelihood is I'm buying those bonds because of the diversification and the income. It's hard to sell my bonds, even though bond prices will likely fall when interest rates go up in the next short while. So you really want to hedge against that. So what we're bringing is an inverse Government of Canada 10-year bond product, which gives investors the ability to go and buy this, and really, if interest rates rise and bond prices fall, you'll benefit in a positive nature from that to offset your core bond exposure in your portfolio.
But it's not a core bond product, it's sort of the Explorer.
Absolutely. There's a period in that product where it might have a ton of money in it, and a period where where we recommend to have 0. When rates are actually falling, you likely don't want to be invested in that type of product at all.
Now, how about global bonds for Canadian investors through Claymore's Canadian ETFs? Are you allowing them to play the yields as they kind of go up and down internationally? We actually think global bond investing is a currency trade instead of an actual bond trade, because the currency movements of a global bond, so let's say a bond in Europe or a Japanese bond or a US bond, have more impact than the actual bond price or the yield in that currency that country actually represent. So we actually look at global bonds more of a currency play. And it's a really challenging product to bring, in the sense that for Canadian investors, we actually look at Canadian bonds provide you with phenomenal exposure. Where they don't provide you with that diversification is really when you go into the sort of lower investment grade or really high yield markets. And so those are the types of areas where I think global bond investing might make more sense. But in high grade corporates and government bonds, there's really no reason for a Canadian investor to be investing abroad. Great. Well, thank you very much, Som Seif, the president of Claymore Investments in Toronto. Next time, we're going to look at how to cope with stock market volatility with your ETFs.
Great.